Institutions have just released a list of all the stocks they have been buying, and today's episode we want to identify those that have been beaten down heavily and they continue to pour money in, not the likes of Microsoft that are trading near all-time highs. And what makes it even more important in today's episode is that institutions are also selling a ton of shares, and therefore we want to understand which of those that they have a lot of faith in, especially given the market is now sitting at all-time highs. In just the last week, we've seen many companies perform very well. The semiconductor space has seen the likes of Nvidia up 10%, AMD up 12%, and we even have the unloved Google up around 7%. Also worth pointing out, a very rare occasion where Palantir is down around 5%, but as we said, market is sitting at all-time highs, which didn't feel likely during the Liberation tariff sell-off. On top of that, we've also got investor sentiment sitting now well in greed, lots of buying going on for what we would say are some now very high valuations, but maybe there is some merit to see the market looking fairly buoyant. We have the White House announcing the China trade deal has been signed, many more supposedly are now in the pipeline, and even though we have Jerome Powell taking a view that we should wait and see on rate cuts, something that Donald Trump has spoken about in a very aggressive tone, the way he isn't a big fan, he is looking to very soon announce the next Fed as Jerome Powell contract comes up May next year, which is buoyant for the market as many believe we will see a ton of rate cuts in 2026. And it wasn't that long ago where we talked about OpenAI, where they accused Meta of trying to poach some of their staff, offering them some incredible $100 million bonuses. And just over the last few days, we've actually seen that come into fruition, whilst the article notes on the 25th of June that 3 researchers have moved across. This number is led to be around 7. So let's get straight into it, into these stocks. Now, the first stock is United Health, where institutions with their 88% ownership have actually been selling $36 billion worth of shares in just the last year. But not only have they bought nearly twice as much at $56 billion in the same time frame, in the most recent quarter, we see again double the buying at $20 billion versus $9 billion selling, telling us institutions clearly love this company. And it's not only institutions that are buying, insiders, although we see very small ownership at 0.3%, with their $2.7 million worth of selling in the last year, we've seen quite a large number of buys at $32 million. And remember, as we say, insider buying is a bullish signal because management believe the share price will go up over time, and we can see it's also in the most recent quarter. We're talking Q2, 32 million buying, 180,000 selling, and we'll actually show you for transparency who these insiders are. We have in fact the CEO and the CFO buying around May as well as June, and we get quite a significant amount, 25 million in one instance, another 5 million, and then an amount here for 180,000. And we can see that over the last year, the company's been battered down 36%, year to date down nearly 40%. The reasons why we won't cover today, as we've looked at that extensively on the channel. And over the last 10 years, even with the huge drop, they've still outperformed the S&P, up 154%. Now they're trading not too far off their 52-week low, with a massive dip from their highs at $631, and both Wall Street and Seeking Alpha consider this a great opportunity for the portfolio. We're talking around 4.07 out of 5, and we also get severe undervaluation. We're talking a forward P 13.7, well below the 5-year of 20.2, not only below, in fact, one of the lowest it has offered to shareholders as well as prospective investors, and the same that we can see on the yield, 2.9%, nearly the highest they've offered to investors over the last 5 years, and well above the average at 1.4. And we also notice this exact confirmation of severe undervaluation when we look at the blue tunnel methodology, clearly highlighting the fair price of the company and we see disparity between where the company sits today and even the bottom end, something we have seen for quite some time now in 2025. But actually, if we zoom out to over the last 5 years, you will notice that from 2020 to around 2024, the beginning of, there wasn't one day where you could have added this at an undervaluation. It was trading at both a severely overvalued level and a reasonable signal. So definitely something you could argue a great opportunity to consider if you believe in the longer term of the company. But also look at their free cash flow growth, very impressive, increasing consistently over the longer term, something we want. Granted, there was a dip into 2024, but anticipated to continue to rise over the next 12 months. Now, on their valuation grading, we do notice a B-. Actually, quite good to see. It trades at a discount to the sector. We're talking 21%. And as we just highlighted, as of today, you're getting around a 32% discount to their own 5-year average. Not only that, no matter which valuation metric you look at today, you're getting both a discount to the sector as well as their 5-year. However, what we would say is you could consider whether the company deserves to trade at a discount to the sector. Their growth sits at an F. Year-on-year revenue and forward-looking 8 to 9%, which is actually marginally above the sector around the 7 to 8%, yet we do note over the last 5 years they were growing slightly higher. In terms of earnings per share, it is projected to grow 6% over the next 3 to 5 years, which is below both the sector at 10 and their 5-year at 13. But one thing that is very strong for this company is their profitability, where they get an A+. Now granted, gross margin 22% is below the sector at 59 and their own 5-year at 24, but their bottom line of 5.4 is significantly better than the sector, where they're losing money, negative 2%, and pretty much in line with their own historical. They also do generate a ton of cash from operations at 28 billion, when the sector, as we said earlier, burning through cash, negative 11 million, and they're also generating more cash than they have done over the last 5 years. We should also make you aware that over the next 4 quarters, only one of them they're expecting growth to the EPS with a 75% track record, but more importantly, they did miss the most recent earnings by 9 cents. And for those that do like to look at the next full accounting period, they're trading based on EPS at a forward P of 11.9. Now, each one of these companies, we want to offer to you our own intrinsic price, where we get to $403, the average of the 4 models that you see on screen. And when we do our deeper dives, we actually run through every single one of these models, talking about our inputs and outputs. But today we want to dive straight in, and as a reminder, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for United Health or any others. Then we get to the margin of safety. We always like to start off with 10%. We execute buy on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode, a buy for UNH up to $363, then we keep going till it's near the current trading price. And in essence, we're saying this company, UNH, is near a 25% MOS at the $303 mark. Right now, though, up to $322, you are getting 20%. So UNH, near a 25% MOS, Wall Street themselves, very bullish, institutions buying billions, insiders buying millions. Wall Street see this $400 into 2026, upside of 30%. Give us your thoughts. MOS 25, upside 30%. UNH, stock number 1, buy, hold or sell. Before we move on to the next stock, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning, so a fresh copy coming to your inbox tomorrow, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. You will also be able to grab a copy of severely undervalued stocks for the month of June. We'll also be dropping July's copy in a couple of days. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is Zoetis, which institutions hold 93% ownership, around 7.8 billion worth of selling, 13 billion worth of buys, and they've bought more than twice as much in the most recent quarter, 3.8 billion buys, 1.6 billion sells, and this company is down 12% over the last year. Year to date, down around 4%, but over the last 10 years, similar to UNH, outperformance of the S&P up 224%, where their all-time highs sit around the back end of 2021 at $243. Likewise, it is also trading near its 52-week low with a double buy from Seeking Alpha in Wall Street, and we also get that severe undervaluation signal with the forward PE 24.6 below the 5-year of 32.3, but also actually the lowest is offered to investors with a yield of 1.3%, again the highest on offer and above their 5-year at 0.84. And we also get confirmation here on this blue tunnel where in fact pretty much from October-November 2024 it has been trading in severe undervaluation, and that's only been increasing as time has gone on. And over the last 5 years you would have at some points been able to buy this at an undervalued level. However, from 2020 to around 2022 it was trading severely overvalued, so perhaps one to consider. And their free cash flow also looking very nice, where we do notice more than 5 times growth from 2015 to today and expected to continue into the next 12. Now their valuation at F does highlight you're paying a premium against the sector, currently sitting at 42%, but actually a discount near 30% to their own 5-year, and again conclusive no matter what metric you look at. Zoetis is trading at a discount to their 5-year, but at a premium to the sector. Now their growth a little bit disappointing at a D-, year on year and forward looking at 6%, only marginally below the sector, but actually they have been growing over the last 5 years a little bit higher, around the 8% mark, with EPS projected around 10%, pretty much as noted in line with both sector and their 5-year. Profitability looking very strong, 71%, well above the sector at 59%, pretty much in line with their historicals. In terms of bottom line, net income, well 27%, sector itself burning through cash like we saw with UNH, and we also notice not far off their own 5-year average. Cash from operations, good to see it increasing to 3 billion when over the last 5 years it's been towards 2.2, and again sector negative 11 million. Always love to see this green right across the board. Next 4 quarters anticipated growth, 100% track record, trading on next full accounting period, forward PE pretty much 23. Now intrinsic value at $226 will give a very attractive MOS. At 10%, a buy at 204, at 20%, 181, at 30, 158. What we really notice, not at 35% just yet, you're getting at least 30%, high quality company. If you like any of these we go through today for a deeper dive, let us know. And Wall Street themselves see this at $200 into 2026, 28% upside. Zoetis, 30% MOS, 28% upside. Is this one for the watch list, or in fact a buy, hold or sell? We then move on to the big pharma Eli Lilly with 83% institutional ownership, 44 billion worth of sales, pretty much 3 times amount of buying at 127 billion, and we notice a lot more buying, more than 6 times in the more recent quarter, 72 billion buys, 11 billion sells, and this one has been battered 15% over the last 12 months, pretty much flat year to date, but over the last 10 years, such significant outperformance, up 800%. Now 52-week range does show it trading towards the 52-week lows with a healthy double buy from Seeking Alpha in Wall Street, and we also get another severe undervaluation. Whilst in isolation a forward P of 31 may look high, historically it's been around the 38 level, yet we do notice the yield of 0.8% is lower than what they typically offered at 1.2%. Now on this method we do get severe undervaluation, we do see the disparity, but in this last 12-month period we've seen undervaluation, we've seen a reasonable signal, and in fact we've also seen months where it's traded at an overvaluation. And even more interesting, when we zoom out to the last 5 years, we actually note the majority of this time, in fact from 2021 to around the end of 2024, this company has traded in a severe overvaluation. So this does mean typically Eli Lilly trades at a very large premium, but at the same time, great to see the blue tunnel intrinsic value increase year on year. Free cash flow does look a little bit inconsistent though. We get some years where it's grown a little bit, some years where it drops. In fact, 2023 it was negative, but we do anticipate the next 12 months to be a very large increase. Now, probably no surprises on the F valuation as you are paying a 100% premium, but against their own 5-year, we can see the discount, something that is noted pretty much over the vast majority of valuation metrics, but they do actually at the same time trade at such a high premium to the overall sector. Now, growth A+ is really what you want to see for a company trading at such a high valuation. 36% year on year, 28% forward looking, well above the sector in the 7 to 8%, but also they're growing faster than they have done over the last 5-year period, with earnings per share looking very attractive, 33%, well above the sector at 10, and a big improvement on their own 5-year at 22. Profitability also very strong, 82% gross margin, not only above the sector at 59, but we're seeing efficiencies to their margin. Their own historical was lower at 78, and bottom line, 23%, again, sector burning through cash, and a slight improvement to their own 5-year, with cash generated from operations 50% higher at 9.3 billion than their own 5-year at 6.6. And they also anticipate at a bare minimum over the next 4 quarters to be double-digit growth with a 50% track record, so a little bit questionable in terms of whether you believe them hitting these targets. Most recent one, a 12% miss, trading on next full accounting period at a forward P 26.2. Now, our intrinsic price gets to $691 derived from the DCF model. Now, we'll show you it is just one model to show you how much is already baked into the growth to see whether or not you believe in the current price. Now, growth rate 35%, as you can see, low, medium, and high, 30, 35, 40. Numbers, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Eli Lilly or any others. But based on the growth rate, in fact, the average sits at 44, most recent 374%, and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 691, indicating downside of 11%. Now, for those that believe it is way too high at 35, which isn't something unreasonable, at 30%, 491, 37% downside. So ultimately, if you are buying Eli Lilly like the institutions, you need to see around 35 to 40% growth rate, where at 40 it gets to 958, 24%. Now, we will take through the medium as we typically do on the channel, but this is highlighting to us, given the current price, Eli Lilly, in our own opinion, is trading at a premium. Institutions are buying, Wall Street sees it as a buy, where their price target is $1,000 in the next year. That is upside of 29%. Now, for consistency, we will show you the MOS at 10%, a buy at 622, at 20, 553, and at 25, 519. But as we said, in our view, trading at a premium. Let us know though if you agree. We then move on to BMI, Bristol Myers Squibb, with 76% ownership, 8 billion selling, double the buys at 16, and we actually see triple the buys in the most recent quarter, 4.5 buys, 1.6 sells. Now, over the last year, it is up 12%, year to date though, down 18%. Over the last 10 years, actually, if you invested in this 10 years ago today, didn't reinvest the dividends, you would be holding on to less cash, in fact 31% lower, but it does trade near the 52-week low. We see 52-week high at $63, with a buy from Seeking Alpha, a hold from Wall Street, but a strong buy from Quant. Now, we do get another double severe undervaluation signal, forward P7 when the 5-year sits at 8.4, yield 5.4, very attractive, well above the 5-year at 3.3, and we also notice another severe undervaluation signal, something you can see has occurred a few times over the last 12 months, something however that is very common when we zoom out further, although we would say bear in mind the intrinsic value has been decreasing, definitely something to keep an eye out for. But free cash flow for the large part does look very attractive in terms of the increases and expected to continue moving forwards. Now, valuation, they get an A+, massive discount to the sector, we're talking 61%, but also a 63% discount to the 5-year. In fact, discount every single metric unless you're looking at a price to book. Growth grade, they do get an A+, although whilst revenue year on year at 5% looks good, forward looking, anticipating a 2% drop when the sector sits around the 7 to 8% level, and their own 5-year does in fact look to be sitting higher. Thing that does really help is earnings per share expected to explode to 60% over the next 3 to 5, well above the sector at 10 and their 5-year at 6, with profitability looking strong at an A+, 75% in gross margin, well above the sector at 59, although lower than their historicals of 78. Bottom line, 11%, again similar sector as others today where it has been burning through, -2, but a lot better than the 5-year at 1, and cash generated from operations at 14 billion, a little bit higher than historicals of 13.9. Now they only expect one of the next 4 quarters to be growth, although they have a 100% track record, trading on December 26 at a forward P of 8, and our intrinsic value gets to $66. Now one thing we do want to highlight that is on the discounted cash flow valuation, which has the highest amount at 75, we have had the expectation moving forwards of -2%, something to consider. You could argue that is fairly conservative, but what this ultimately does, with the valuation being the average of the 3, really highlight that this company is trading at severe undervalued levels if you deem 30% MOS to be attractive, whilst also getting an attractive yield above 5%, and Wall Street themselves seeing this at $61 over the next year, 33% upside. Give us your thoughts though, maybe one you like, maybe one you dislike for whatever reason. In your own opinion though, buy, hold or sell. We then move on to PepsiCo with 73% institutional ownership, around 10.5 billion worth of selling, twice as much buying at 20 billion, and we also see that reflected in the most recent quarter. 5.5 billion buys, 3 billion sells. Now this company has been battered down 21% over the last year, year to date down 14%, and over the last 10 years up only 39%. Granted, this doesn't include dividends reinvested, nonetheless, so far underperforming the S&P, trading pretty much at its 52-week low, quite some way away from the highs at 181, and interestingly, the first time today, institutions may be buying, but seeking alpha, Wall Street and quant call this a hold. Now we get double severe undervaluation, forward P of 16, well below the 5-year of 24, lowest on offer in the 5-year period to prospective investors, yield being the highest at 4.3%, well above the 5-year at 2.9, and we also see that reflected on the severe undervaluation blue tunnel signal, disparity between the 2 points, lower and the current trading price, but also one that over the last year consistently trading in these undervalued levels, something that has been pretty consistent from the beginning of 2024. Before then, from 2020 and 23 included, this company has for the most part been trading in a reasonable signal, and maybe not something we want to see as investors who like free cash flow growth over the longer term. This company has been pretty much stagnant in terms of the movement, but over the next 12 months, we are anticipating a larger drive to higher free cash flow at 752. Now their grading comes in at a C+, pretty much trading now in line with the sector. You're paying a very marginal 3% premium, but as we highlighted earlier, you're getting a discount sitting around 29% to their 5-year average, one that is consistent right across every single valuation metric, but we do notice against some in the sector like EV to sales, EV to EBIT, and price to sales, price to book, this company still trading at a premium. Growth is very disappointing though at a D, where we see flat year on year, 1% moving forwards, that is below inflation, so real terms decreasing. Sector not much better, around the 2 to 3% point, but what makes it even more disappointing, over the last 5 years, the company was increasing around 5 to 7%, right now significantly lower. EPS not the best moving forwards, 3 to 4%, lower than both sector at 6 and their 5-year at 7. Profitability does look good though at an A+, where gross margin sits at 55, well above the sector at 36, a little bit higher than their 5-year at 54. Bottom line, pretty much the same to be said, 10% above the sector at 4, but this one is in line with their own historical at the same level. Cash generated though has increased marginally to 12.5 billion from 11.5, and that is significantly higher than the sector at 850 million. Now over the next 4 quarters, 3 of them expected growth, 75% track record, with the most recent one marginal 1 cent miss, trading on their next full accounting period forward P 15.6. And our valuation of $152 does give you a margin of safety for this Dividend King. 10% buy at 137, at 15%, not quite there yet, not that far off, pretty much where the 52-week lows sit, with Wall Street anticipating 16% upside into 2026, $152 price target. Is this one to consider? If you want a 20% MOS, you would have to wait for 121, at 25, 114, and for those that want to see it 30, 106. PepsiCo, very attractive yield. Dividend King, 15% margin of safety, 16% projected upside. Let us know your thoughts. We then move on to General Mills with 76% institutional ownership, $3 billion worth of selling, double the buying at $6 billion, and we notice more than double the buys in the most recent quarter, $2.3 billion buying, $900 million selling, and we also noticed that in the previous quarter, if you wanted the reverse of the trend, you would have to go Q4 23. Now this one battered 21% over the last year, year to date down 21, over the last 10 years also down around 11%, all-time highs $91 2 years ago, and we can notice trading at a 52-week low, massive way away from their highs of 76, with, similar to PepsiCo, every single analyst giving this a hold. Now this does follow the same pattern as PepsiCo, where we get a double undervaluation signal. Forward P, lowest investors over the last 5 years, well below the 5-year. Yield is nearly at the 5% point, well above the 5-year at 3.3. And we also get that severe undervaluation signal, something we have seen for the best part of the last 12 months. Yet when we expand to the last 5 years, that wasn't something that was very consistent. In fact, from 2020 to around mid-2023, end of 2023, this was around the reasonable / even overvaluation point. And like we said, a lot of these traits of the company follow PepsiCo, including their free cash flow, very stagnant year on year, not much movement, and a drop is anticipated into the next 12 months. Now valuation comes at a B, as you are getting a 16% discount to the sector, also as highlighted a discount of 18% to their 5-year, and pretty consistent across the majority of metrics. This one is trading at a bit of a discount. Growth, this is probably where the company lets it down a lot, and one you could argue probably what makes PepsiCo sit in the driver's seat, because revenue year on year and forward looking, we're talking negative 2%. The sector pretty much the same as PepsiCo, around the 2 to 3% point, which is where this company was growing over the last 5 years. Earnings per share also a letdown, negative 2% projected, 6% in the sector, and even their own 5-year was higher at 5%. Profitability does look okay at an A-, gross margin 35, a little bit below the sector, in line with their own historicals. Bottom line 12%, well above the sector, a little bit below their 5-year, so actually revenue's been decreasing as well as their effective margins, and in fact EPS is projected to fall. We also notice cash from operations at $3 billion, lower than their average at $3 billion, but well above the sector at $850 million. Now they only project one of the next 4 quarters to be growth, but do have a 100% track record, trading on the next full accounting period at a forward P of 13.1. Now our intrinsic value, as a reminder, is just the average of these 3 models, which you can grab a copy by clicking below, comes to $61, offering a 10% MOS up to $55. At 20% isn't that far off at $49. Wall Street also anticipates $60 into the next year, upside of 20%. So whilst the numbers aren't looking the greatest in terms of a revenue decrease, cash from operations falling, as well as EPS, you could argue that the market has overreacted and maybe giving an opportunity, especially for those that do love a very high yield. 20% MOS for those that want to see 25, a buy at 46. But as we said, 20% MOS, 20% upside. Let us know your thoughts on General Mills. We then move into the semiconductor space with Qualcomm's 74% institutional ownership, 14 billion selling, 20 billion buying, and more buying in quarter one, as noted, 4.2 billion buys, 3.2 billion sells. And if you want to see the reverse of the trend, very marginal movement in Q3, you would in fact have to go to around Q2 2022, where double the amount sold than that purchase. Now over the last year, it is down around 19%, year to date though up 3%, and over the last 10 years, this one's outperformed the S&P, up 151%. trading towards the lower end of the 52-week range, with a double buy from seeking alpha in Wall Street. Now we do get an undervaluation signal, not as severe as some of the others today, 13.6 versus 14.9, as well as a yield of 2.3, marginally above the 5-year at 2.1. And whilst we do note a reasonable valuation here, it is just within the blue parameters, so you could argue potential undervaluation. Although if you go back to April Liberation Day, we did in fact see this trading at a severely undervalued level. And if you zoom out to over the last 5 years, there was a very long period where this company was trading at severe undervaluation. And even though it's in a cyclical industry, we quite like the growth on the free cash flow. We're talking 4 times over the last 10 years, expected to continue into the next 12 months. And whilst their valuation gets to see, you are getting a 43% discount to the overall sector, a 16% discount to their 5-year, and for the large part, discounts pretty much in both areas. Growth comes to a D-, but year on year 16%, forward looking respectable at 7, which is above the sector and not far off their own 5-year around the 12% point. And if we get to the earnings per share, that's probably what lets this down, only 6%, well below the sector at 15, and likewise their own 5-year. Profitability comes in A+, with gross margin at 56%, above the sector at 50, little bit below the 5-year at 57. Bottom line though, looking very strong at 26% when the sector sits in the low single digit, and also an improvement on their own historicals, with cash generated from operations continuing to climb, 13 billion, 5-year at 10 billion, and the sector a lot lower at 117 million. Now they anticipate 3 of the next 4 quarters to be growth, 100% track record, trading on the next full accounting period at a forward P of 13.4, and our intrinsic value at $201 will give another respectable margin of safety. At 10%, a buy at 181, at 20% around 161, and at 25 around 151. Not quite there yet, so you are getting at least 20% for a margin of safety. Wall Street see this at $190 into the next year, 20% upside. Let us know whether this is one that is on your watch list, one that you're interested in, as well as if it's a buy, hold, or sell. As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.